Let me get this thing turned on real quick. The camera going, get some things moved around. Good morning, good morning. Good morning, Brenda. How we doing? Hey, Kevin. Good to see you all. Hope you're all doing well. Welcome out to the Trading Coaches Playbook. Just making a couple little minor adjustments here, shifting things around. Hello, Helen. Welcome, welcome, everybody. Let me get the disclaimer taken care of. You should all know this by heart by now, right? We're not registered broker-dealers, investment advisors. I will not give you any recommendations or advice. Everything we do here is purely for educational purposes. If I do mention a trade or say something about a trade, just assume that it is a practice or a paper trade. For regulatory reasons, we do not discuss funded trading. So with that, do a quick review of everything that's coming up here in the next little bit. Hey, Clifford. Inner Circle is coming up on the 30th, just 3 days away at 8 o'clock Eastern time. And then Trading You, of course, is twice a month for those of you that are in there. Patterns of Flash with yours truly, September 8th and the 22nd. We'll be doing that again. So last week was fun, of course, like usual. Try to have some fun, right? And make some money. That's the best part. That's when it's the most fun, right? Charting Your Way to Success is September 17th. Live from New York, right? How many of y'all are going to that? I gotta have my coffee. It's still early out here. Actually, it's not. It's 9 o'clock. I've been up for 4 hours, 5 hours now. And then the mastermind group, of course, is every Tuesday, right? The free online workshops that are coming up, Power Hour, Coaches Playbook, as we're doing now every Friday morning, or noon Eastern time, I should say. I'm so used to Pacific time, so maybe next time, huh, Kevin? And then Tuesdays and Saturday, of course, is Power Option Plays, and Saturdays Cover Call Explore. And thank you, Amy. So if you do want to go to that live class, Charting Your Way to Success, Amy just dropped a link in the chat box for you to jump on that and take advantage of it. I think last I saw there was there was 5 seats left, if I remember right. I'm assuming there's more room. I don't know if there's more room or not. I don't think it's sold out, but it's close. It's very close, I believe. And then E-Mini Think Tank with Brandon is Wednesday and Thursday. I'm curious how many there are, but then of course you can follow social media stuff there. If you don't, you should know that already. So let's take a peek and see what we're going to be talking about today. Market breadth. And this is an interesting deal. It's mainly what we're looking for in the market breadth is the internals, if you will. It's kind of, I don't know if a good analogy is a doctor obviously hooking you up to different machines and stuff if you're in a hospital and monitoring the internals of what's happening, your heart rate and all that stuff. That's essentially what we're looking at with market breadth. And as long as things are kind of just smooth and going along normal, then typically everything's fine. It's usually when things get to an extreme that it becomes a problem. But they're essentially, and of course, just like with every indicator, there's a lot of different ways to go, right? A lot of different ones out there, but there are really 4 main indicators that you're going to see with regard to the market breadth. One is the breadth ratio, which is essentially volume related. And we'll get into this. We'll look at some of the charts here in a little bit. And then the advanced decline line, which is the breadth ratio is volume. It's up volume versus down volume. And I'll get more in depth into this. Advanced decline line is advancing stocks versus declining stocks. And the other challenge to this, especially what makes it a little bit more, I wouldn't say difficult, it just creates a little more time consuming spot. So it's one of those where basically you want to pick the ones that are going to work mostly for you, for what you're doing. Like if you're day trading, the tick and the trend are more important for day traders, right? The up volume, down volume, advancing volume, it can come into play. Some are more short-term in nature. Others are you're waiting for an extreme to see what happens for market turning points, right? But the trend and the tick We'll get into those in a little bit. Those are a little more complicated than the up volume versus down volume and advanced decline line. It's similar. Well, yes, I have a few of these actually that are very similar. So it's not the exact same one. I don't think. I don't know. Was like, are you wearing the same shirt from 2 days ago? Yeah, I haven't changed for 2 days or showered. No, I've got a few shirts that are very similar to this. So it could be, though. Maybe it went through the wash and I'm wearing it again. I don't know. Honestly, I don't pay that close attention. I just throw on something. I can't wear my, what's your OCD? Yeah, I am too. So I can't wear my red nut cut off sleeves. I have some, because I've got a gym in the garage. So I can't wear I've got workout shirts that I have the cut off sleeves to work out in. And I can't wear those, obviously. So I have to put a decent looking shirt on. But the breadth ratio is calculated from the volume going into up stocks versus the volume going into down stocks. So it's a volume calculation that, okay, here's how much volume is going into the stocks that are going higher versus the amount of volume going into the stocks that are going lower. Hopefully that makes sense. I know it's a little bit, it's fairly obvious, but at the same time, it's kind of a mouthful to say it. So it's not just a static volume indicator. It's the volume, the amount of volume going into the up stocks versus the amount of volume going into the down stocks. Again, it's a ratio. And most of these are all ratios. There's a couple that we'll look at on Omega charts too, the McClellan oscillator and the trend I have on there as well. We'll look at that. The advanced decline line, again, this is a relatively simple one. It's the number of net stocks going up versus the number of net stocks going down. And there are advanced decline lines for each specific index. And you can realistically create just about anything you want. Most softwares these days allows you to create any kind of ratio you want, like the up volume versus down volume. When we get into looking at the real-time charts, I'll show you what I mean. But you can take and create your own little index and then create an advanced decline line. I think it's a little overkill. I wouldn't go that far, but a lot of this stuff's already done, at least for what you do. And I'm a very simple trader. I don't like to complicate things because I've been down that road before many a times. In the old days, back 15, 20 years ago, I would have done that. I would have gone back and tried to create my own indicator and do all this crazy stuff. But I've passed that point. Now I'm out of the weeds and I just like the simple stuff. But when it comes to the advanced decline line, there are some things that we're looking for. If it's negative 1,500, it's very bullish. If it's below 2,000, it's extremely bullish. And of course, the inverse of that is true. Whoops. You know what? That's wrong. That's supposed to be a plus. If it's above 1,500, I thought something was weird there. When I started to stand, I'm going, wait a minute. Because some of these, and that's what's tricky, is I can't remember if it's a ticker or the trend. It's inverse. I've got it here, but it's an inverse relationship where the opposite of what you would think is the truth. So that's supposed to be 1,500 is bullish. I can't change that right here. So if it's above 1,500, if there's advancing stocks or 1,500 or more, that's very, very bullish. Above 2,000 is extremely bullish. But at the same time, when it gets really, really, really bullish, sometimes that's an indication of a turning point, right? And that is the bulk of what we use breadth indicators for, is looking for turning points, looking for extremes. So when it gets extremely bullish, that's actually something to watch out for. When it gets extremely bearish, that's also something to be cautious of. So now we'll get to the more complicated ones, the trend and the tick. The trend was created by Richard Arms, right? It's also known as the Arms Index. Some of you may have heard it referred to as the Arms Index. And this is where it gets a little complicated. And this is one of the reasons I like looking at the charts instead of going through the definitions. It's the advancing stocks divided by declining stocks, divided by the volume of the advancing stocks, divided by the volume of declining stocks. So if math is a strong suit for you, this makes a lot of sense. And I probably could have laid it out in a mathematical formula looking deal. Maybe it would have been easier to see, but This is one reason I like charts. And I was always decent with math. So, but this is the one that is inverse to the market. It's the opposite of what you would think it would be, right? So if the trend is at one, one is parity, just like a lot of oscillators we look at, right? Zero, there's a zero line. The zero line for the trend is one. So if the trend is sitting right at one, essentially you've got an equal amount of advancing stocks and declining stocks with the volume calculation in there, right? If it is greater than two, that means there's a lot more volume going into the advancing stocks than there are the declining stocks. And then if it is below 0.6, then there's more volume going into the up stocks. So they're almost the opposite of what you would think. So if it's down below one, that's typically bullish. If it's above two, that's typically bearish, right? In John Carter's book, Mastering the Trade, it's been a long time since I read it, but I do remember he made some observations. He said if the trend closes, and this is based on the closing, right? If it closes below 0.6, market has an 80% chance of selling off the next day. So if you're looking at the trend at an end of day as the close, and it's below 0.6, there's a very high likelihood the next day is going to be down. If it closes above 2, there's about an 80% chance of it rallying the next day. And we'll go look at some charts and see what the numbers actually look like and what they actually happen, and test this and see what it actually looks like on a real charts. And this is one of the other things that I thought was interesting. If after closing above 2, market can't rally, a major sell-off could be in store. So it's, again, the opposite, where if it closes above 2, there's an 80% chance to rally the next day. But if it can't rally the next day, that's a huge warning sign. Now we'll take a look at the tick, and then we'll go play on the charts. This is fairly obvious if you're familiar with the tick and how stocks tick up and down, right? If you ever look at a tick chart, which is essentially every single trade that goes off on that chart, it moves. Instead of looking at a 1 or a 5-minute or a 10-minute or a daily candle, it's every single trade that goes off is a tick. And they are kind of crazy. They can be really, really fast and really quick. But that's what some people use. A lot of day traders use a tick chart. But it's a relationship of stocks ticking up versus ticking down based on their last price, which again is fairly obvious. But typically the tick ranges between 1,000. And I'm looking at it over here on my other screen, and it's just sitting there. It has been sitting between 1,000. Yesterday it hit just below 1,000. I think that was right when the market hit that news came out. At some point it hit there. But if it gets above or below 1,000, that's where it's at an extreme, which is essentially, like most of these indicators, that's what we're looking for, is something that's an extreme, because that typically indicates a reversal point. That when the internals get outside of the norm that they should be in, then something's not quite right, right? Just like the doctor saying, that chart is going off, and I don't know why it takes me back to, my son was born 2 months early. And I remember we were there sitting for a week, right? Was in labor for a week and sitting there and had, all this stuff hooked up and looking at all the stuff and all these different charts. And it was interesting, obviously being a trader, I'm watching these charts tick up and down, and there's his heartbeat. And I don't remember what else there's. I just remember the heartbeat one. It was just, it was just going back and forth, up and down, like a normal kind of heartbeat does, except obviously for, an unborn child inside the womb, it's a little bit different, but pretty much the same. It's just a heartbeat. And sometimes it would drop down to this really low level. And that's when, talking to the doctor, it was that's what was getting him concerned. He said, if it keeps dropping like that, then that's a problem. As long as it stays within this range, then we're okay. And then on day 7 or 8, it kept dipping below this level that he said, that's where I get concerned. And he came in and he said, it's been doing a lot more. The heart rate's been dipping a lot more lately. So I know no, I'm not crying. I have a sensitive eye, or I got hit with a rock. So this eye tears a lot, but so I know it looks like I'm crying. It was an interesting time, but going back to the doctor story. So the doctor came in and said, it's dipping below that level and I'm getting more and more concerned. And if it continues to do that for the next hour or two, we're going to go in and get him out. And so over the next couple hours, the heart rate kept dipping below this level that he said, that's too extreme. It's too far down that I'm getting concerned. He was concerned about, the umbilical cord being wrapped around his neck or something. Obviously don't know exactly what's going on in there. So, but he said, if that heart rate keeps dropping, we're going to go in and get him out. And sure enough, a couple hours later, I kept watching it, of course, and it kept dipping below there. And he came in, he said, it's time, we're going in. So it was pretty crazy, actually. It was really weird because it was within 10 minutes. They were already in the ER and cutting her open to get him out. It was pretty impressive, actually, how quickly and they not only moved, but got in there to get him out as quickly as possible. So, yeah, anyway, crazy story. That's what I think of when I think of these type of indicators, is going back. And the crazy thing is that was 15 years and 17 days ago. So he just turned 15. So blows my mind, but yeah, he's healthy and everything's good. So thankfully. But yeah, that's where the doctor reference came from, is that right there. And it was really interesting just being a trader and seeing that. So if a tick, the tick is usually mostly for very short-term trading, right? Intraday trading for the most part. So if you're day trading, this is probably something you either use or want to use, might consider using. I use it a little bit, but I don't put a lot of emphasis on it. But if there's a high tick and a high price at the same time, that can be a very good indication of the high of the day. And of course, the inverse of that is true, right? If there's a high tick without a high price, then it very likely will continue to go. But if the opposite is true, right? If you have a low tick and a low price, that's probably the end. I think it's coming up to tick season, isn't it? So again, I mean, just like with all these bullish or bearish, you could flip them over the inverse, right? Is it tick season again? I'm assuming you're referring to, I'm assuming that's a joke, right? The tick. Of course, I grew up working in the woods. So when I hear ticks, okay, that's what I thought. I actually had a tick. I was probably 14 or 15. My dad's a forester. So I worked in the woods a lot, and I grew up on 8 acres. And so we were always out running around in the woods. And I remember one day, I think we were sitting at dinner or something. My mom's like, "What's that on your neck?" There's something right on the back of my neck. And it was a tick. Had actually gotten stuck in there and had been there for a few days, apparently. So it was kind of weird sitting there having to take it out. But yeah, that was my only experience with a tick. So it did. Well, that's the funny thing. It didn't really hurt. It was just weird. I had to sit really still, and they, my mom had tweezers and was like, or my dad, I don't remember who was doing it, but it was just, you have to unscrew it, right? Like a screw, because they just bore themselves in there. So it was really kind of weird. But we'll go look. The first thing I want to pull up real quick is, and I don't remember all the symbols, and this is the funny thing, and I'm going to show you all this in here. I don't know if we can make that bigger. Oh yeah, we can. Okay, good. Get up to the A's, the advanced decline lines. And you'll see exactly how many there are. And that's why these are not things that I look at a lot. Where'd they go? I knew I had them here earlier. There's a ton in here. Maybe I'll just put it in here. There we go. So most of the indexes and stuff if you're using Omega charts, most of them start with a dollar symbol, right? And you'll see that there's New York Stock Exchange advanced decline. You can do just advancing issues, right? If you want to see that. So there is, and this is a daily chart, right? So yesterday, 828 advancing issues on the New York Stock Exchange. Advancing issues, if you want to look at the Amex, this is what's crazy. There's all kinds of them. On the Amex, there's 277. But really what I want to look at, there's the S&P 500 cumulative advanced decline. And it just charts that's cumulative. That's not what I wanted. I want just the advanced. There it is. S&P 500 advanced decline. So this is the advancers minus decliners, right? So it gives us the actual ratio, which, as you can see, looks like insanity, right? Which it kind of sort of is. It's a ratio. It doesn't really go up or down. The cumulative is obviously it adds everything up. This is one where we're looking for just extremes, right? Where, on big days on the S&P, when it gets to extreme, you're looking at about 450 on the upside. And then when it gets down to about 375, that's the bottom. So it's kind of like an oscillator. It goes back and forth, right? It doesn't accumulate. It's just waffling back and forth. Now, what I want to do is put the SPX on here and then put a comparison chart on there. Now it looks kind of crazy too, doesn't it? But if we zoom way in, try to make this bigger, what you can start to see is that when it gets to extreme levels, like there, right? You can see the purple line is the advanced decline line. And right as it peaked, it got to a high. That's when the market took off and started to rally, right? We had that little pullback, and you got this area. Let me grab my pen real quick. So you got this section right here where the market's pulling back, right? And the advanced decline line drops to a low down here to basically an extreme. And then it pops really heavy, that huge spike from way down to a low extreme to a very high extreme, which the question becomes, what does that tell us? And that's really what we're looking for, is what information can we gather from the internals, the breadth? And that huge spike from a big drop in advancers versus decliners. So there was a lot more decliners than there were advancers in this huge pullback. And then it completely shifted directions and went to the opposite very quickly, to where we had a ton more advancers versus decliners. And I know it's a little bit hard to see behind there, but that black line is the market, right? So once we went from one extreme to the other very quickly, that indicated a big bullish move. So what happened right after that big change? Took off. And then, of course, it's very convoluted, and it's very difficult sometimes to see, because we've got a similar type of thing, right? We've got lots of advances, and then it dropped off to right before the drop off, but that didn't give us a very clear indication. That's what's tricky about everything, right? Is you never know when to expect the big change, because we had a couple of spikes here and 3 spikes down here. And then more recently, of course, I got to get rid of that pen. Clear all that stuff. We had the big spike last week. Come on, where'd it go? I don't know how to make that thing stay there. Of course, the little sell-off last week and the advanced decline line gets to an extreme, which, no surprise, creates this pop. And the advanced decline line comes back up here. The question is, it's not really up at a major extreme like it was here. So these are a little more sensitive. This, even though this and this difference doesn't look like a lot, it is. So the extreme up here, if this thing would have come way up here to the extreme, the advanced decline line, then this thing will probably keep going. But yesterday obviously dropped off with the news that came out yesterday, which was a sad day, obviously. Not a good thing to, not a good piece of news to have come out. And even though I've got some bearish positions and I was content with my positions, happy with my positions, the news was not a I don't like having stuff happen like that with that kind of news, but so there's a little bit of the advanced decline. And then I want to get to, well, let me pull these over. The McClellan oscillator too, I wanted to touch on that and I forgot to add that into the PowerPoint, which this one is actually, I think, better for extremes as far as the larger trend. I'm going to get rid of this, the trend. There's the trend. We already talked about that. This one, McClellan oscillator, I meant to put in there. But essentially, it's just like every other oscillator, right? Y'all familiar with stochastics, and this essentially is another one we're looking for extremes. And I like this better than the tick and the trend are great for intraday. The up volume, down volume, advanced decline, and doesn't do a lot for me. As you can tell, I don't get that excited about it. McClellan oscillator, I actually like. It's cleaner, neater, and I just think it's a better way to go from an indicator perspective. And if we look at a little longer time frame, whoops, brought that back up. Just like every other breadth indicator, we're really looking for extremes. And I've got this set on a histogram. You can have it do it a line chart. I just like the histogram better. And if we go, what you'll see, if we go to the parts that are extremes, like right there on that day. Okay, let me actually zoom that in so you should be able to see it a little bit better. The McClellan oscillates from 0 to wherever it goes to. There is no high or low on it. But whenever you see a big extreme like this, that's usually an indication that the run is over, whether it's bullish or bearish. But you can see a huge drop off, big spike down to 250, and then it rallied. Same thing back here. I mean, this is not rocket science, right? It's pretty simple. Except for when you get to places like this, when you have an extreme sell-off, and that's what's challenging about every indicator, right? They always, you never ever know when it's going to be, when the extreme tells us, okay, it's time to get in. Because obviously, if you would have bought here, when it got to a major extreme, which this was the COVID sell-off, right? So that's where it is important to also put into context what else is happening. If you're having news like, the COVID news releasing and breaking, then maybe the McClellan at an extreme will stay there, as you can see is what happened for several weeks. It sold off, and the thing just kept on tanking, right? And then on the flip side of that, we got two extremes here, right? You got some bullish extremes, which would have told us that the market was possibly getting weak. I mean, not weak, but it was strong, but almost too strong, right? It's the inverse of it. When it's showing a lot of strength, that's the time to get out. But this right here is a lot of news-driven craziness. So when you put it in context, you go, okay, there's a lot of news there. Maybe not. But that's also a time, and it's one of the main reasons that we use stops, right? Because sometimes the indicators will give us bad signals. And when there's news like this, that's exactly what happened there. But then when we come back to some of the others, and we get back to relative normal, which happened later last year, then you can see there we got the McClellan came down and hit that extreme, a low, Whoops. So on a pullback, we got a 3 or 4 week pullback. It finally hits a low. We had quite a few weeks of declining, lots of declining stocks. And then it reversed and popped up. Of course, right here, you have several weeks of a rally, but it didn't really get that high. The extreme wasn't that high. So up here, upwards of 300. I'm trying to remember the range. I think anything above 300 on McCullen is very bullish, which is a warning sign that it may be getting ready to turn. And anything under 300 is the opposite. So that's one other indicator to look at. But let's get to the tick and the trend. I think I was going towards the tick, right? Staying away from the tick. And this is another one too, that there's, I don't want the cumulative. There's a tick on every single index. So if you're trading just NASDAQ stocks, you can go look at this. If you're trading just S&P, I don't want the cumulative. We'll look at the tick of the Dow. How's that for a chart? It's a little bit crazy, right? So if we put it into a line chart, again, these are a lot like just basically oscillators that we're looking for extremes. We're looking for a crazy spot. And let me get that on there. Whoops. I want the tick for the NASDAQ or the Dow. So we're looking at the Dow versus the tick, same as we did the other one. Do a comparison. And obviously a longer term chart like that, it doesn't work for, but really just looking for major extremes, usually major divergence is really what we're looking for. And there's some spots you can see right here. We got there. Of course, here's another spike to the downside, right? When the tick dropped off big time. And it didn't really matter. It doesn't work that spectacularly on daily charts. The trend can. Let's get to that. Because the tick is not, it's mostly intraday. In fact, it's starting to drop off right now. What's the market doing? Still rallying. Russell's going crazy today. The trend I have here on a daily chart, which you can see, this is another one. It's not that much different than the McClellan oscillator. You'll see that the spikes happen all about the same time. So if you happen to have the trend on your daily chart, you can see that when it spikes above about 3, we get a major reversal basically the next day. So this can be a good indication when we have a sell-off. I like the trend for this reason. As you can see, just in the last few months, we get a pretty significant sell-off for even just a day or two or a week or two. And the trend spikes big time. And the next day it turns up and goes back up. There's some back here. There's another one there. When you look at each of the extreme spots of the trend, most of them, there's a couple exceptions there, but so now I want to pull up intraday, and we'll look at some of those, see what's happening today anyway. Apple's one. So getting to the intraday tick and trend, and I have basically these ones set up here on a separate chart. The upper left chart, actually, I'm just going to make that big so you can all see it better. The upper left chart there is the up volume versus down volume. I don't know if you can see that up there. There's an up volume versus down volume. This one over here on the top right is the advanced decline line. And then this is the New York Stock Exchange tick. And then the New York Stock Exchange trend, which, which one do you use? I know it's maybe some of you are thinking that. Which one do I use for what I'm doing? If you trade mostly NASDAQ stocks, then use the NASDAQ. If you trade mostly New York, use New York. Or S&P. I don't know that it really matters that much. They're probably all going to be pretty similar. But the up volume versus down volume, you can see this doesn't do a lot for me. I mean, it's pretty obvious. The market's up today quite a bit. Yeah, I mean, SPX is up 37, NASDAQ's up 163, and Dow's up 235. So this is pretty obvious. I mean, if the market's going up, that's going up. Advanced decline line, it is definitely slowing down, which could be an indication that, intraday at least, we're maybe looking for a reversal. These are 1 hour charts, by the way. So this is 1 hour of what's going on. So each of those candles is an hour. So we're definitely slowing down a little bit on the advanced decline line, and we're above 2000, which is a bullish sign, right? So things are pretty extremely bullish right now. Will it stay up there is the big question. And it certainly looks like it at this point. It looks like we're going to keep marching higher, but so that is definitely a bullish indication. The up volume, the tick down here though, and you can see this is an intraday, obviously. I'm just making sure I have these all set on 1 hour charts. So I had them all set right. So when it gets to the extreme up here at 1000, okay, it goes above or below 1000 is when we are looking for a shift. I'm going to move this over, try to get a Dow. I love having to switch symbols. I want to basically just look at a comparison here. Where did that go? Kind of wish I could share both screens, but I can't. So I got to shift these things all around. At least I don't think there's a way. Is there a way to share two screens on this thing or not? I don't think there is. Oh, you know what? I got a better idea. There we go. Now we'll get them stacked and make sure they're on the same time frame. So the tick, as you can see, and a lot of times this is in the first hour, you can see this day here. Grab my pen. If I did, it'd be super small. But I'm not sure what you mean, Will. Oh, two screens. Yeah. Okay. I forgot about that. Yeah, that's why I have never looked at that. So it'd be nice though. Of course, if I was on my trading machine, I've got a 49-inch curve monitor on that, but that'd be too small too. I'd like to use that, but I think it'd be easier. But you can see that the tick this day, and a lot of times this happens on the very open of the day. It gets to an extreme. And this thing jumped up to what's that, 1300, the first open of the day, and that's this candle right here. This was Monday morning, right? So out of the very first open, in the very first hour of the market, you had a tremendous amount of stocks that ticked higher right out of the gates, which makes sense. You got a big gap, right? Not a huge gap, but a pretty good sized gap. And then it dropped back to normal. The first part of the day, as far as the tick goes, if it's the very first part of the day, I don't pay a lot of attention to it. If it's in the middle of the day, things get going, then that's a little different story. Here it came up Tuesday. Same thing, first part of the open, it basically hit right at 1000, which there is the close of the day on Monday and the open Tuesday. So that's no surprise you get a gap. When you get a gap, this is likely to happen. So I wouldn't, in the first open part of the day, I wouldn't pay attention to it. What you can see today, though, if we get rid of that. I'm going to zoom this in a bunch. Today, we got upwards of 1,000 right out of the gates, right? We had a little tiny gap up this morning, and then it take off and ran. But we didn't hit 1,000. So it didn't really tell us much at all. I want to see if, where did my 4-chart thing go? So the tick, we're basically just looking for 1,000. The trend's what I want to jump to now because I like that better for an intraday. Let me make that full screen. So the trend is the one where we're looking at, one is parity, right? So this is where we've got basically stocks going up versus stocks going down are about the same. And you can see yesterday morning, let me get back to that one, actually. I wanted to look at the Dow. There it is. Actually, I'm not seeing that. It doesn't look right. I don't know what's going on there. I'm not sure what's happening with this. It's just weird. I don't know. I just lost my train of thought. Anybody have any stocks they want to look at real quick? I can't remember what I was going to show with the trend here. I totally lost my train of thought. So how about this? Let's just jump. Let's take a look at some stocks and see if there's anything we can compare to. Anything we can look at with the trend or the tick and see if there's anything intraday that will show us that we can use it for. The Qs. Okay, Clifford, I was going to look at Apple, but let me get rid of that real quick. Actually, there should be. I don't know if there's a trend on the Qs or not, but anything specific on the Qs, Clifford? Are we talking daily? Are we talking swing trade? Are we talking, what are we looking for exactly? Just curious if you're, what you're looking for. Jump to hourly. Okay. So we're looking at intraday trade then. Obviously, well, going back to that daily real quick, a little bit of a rising three taking place, right? So getting back to patterns, what I specialize in, the rising three method is basically taking place, but then we jump to an hourly. And obviously slowing down a little bit, right? Nice little pop this morning with lots of volume. A little doji after it, and then another little continuation, but slowing down, right? Bullish engulfing. Are we talking on hourly now, Brenda, or are you talking daily? Because I'm not seeing on a daily. I'm not seeing that. I'm not seeing a bullish engulfing pattern, but I see a piercing pattern here. But are you talking about today's candle? Yeah, agreed. Yeah, I gapped up a little bit. A bullish engulfing, it would have gapped down a little bit this morning. It would have gapped down to this area here. But as far as on an hourly chart, Clifford, I'm not seeing. I mean, as far as trading, getting into something like this, bullish or bearish, I guess is the question. Because right now it's run so far today, I wouldn't be terribly excited about getting in a bullish trade unless it breaks above 376. If it breaks out to a new high, Let me get back to a daily and look at it here. I mean, we're basically all-time highs, are we not? Look at it here. Yeah. So we're all-time highs. So the question is, and there's the tough part, is at what point does this rally slow down or stop? So we're breaking out to all-time highs, and that's not a bad place to get in if it continues to rally. But that's the part that always makes me a little nervous, is that we've got this big push for the last 4 or 5 days. And big rallies like that eventually slow down. But this is, obviously, here's the previous highs. We'll put that on close there. So if I was going to get into something like this and trade it bullish, I'd have my stop just slightly below there, probably right below 374. Just because if, especially going back to a daily chart, we're up 15 points in the last week and a half. Typically, it's either going to go sideways, because when you look at these big runs, you've got this one from here, right? 350 to 368. It's about 13, 14 points over 5 days. And then it just went sideways for a month after that. It dropped off, then went sideways here and there. So usually when there's big runs like this, I would expect it to go more sideways. But there could be another 2 or 3 or 4 day rally in it. That's what's hard about it, right? You don't know if it's just going to keep taking off or not. But that's where I always look at things from an odds perspective, is what are the odds that this thing is going to run another 3 or 4 days, have another 3 big up days versus going sideways. And odds wise, the odds are it's probably going to go sideways more than anything, just like it did here. But there's what's tricky is, see here, you got 2 big days, doji day, little down day, and then it kept running a little bit here for about a week. So I know I'm parsing words, but it's not a bad place to get bullish, but I'd have a super tight stop. That's probably the easiest way to put it. Does that make sense? Let's see, what else was there? Somebody else had one they wanted to look at. Veil or ET for a swing. I'm going to look at Omega charts. Veil. Whew. Bullish or bearish, I guess is the question. Because it doesn't look very bullish right now. Just dropping some lines on there real quick. Bullish. Well, I would be not terribly excited about a bullish, mainly because, I mean, you look at the action in the last few weeks. Big sell-off. Is that earnings related? The initial drop there is earnings related right back here. And then it continued for a couple of weeks after that. And an acceleration of volume here on the drop. You fill it. You mean the, you're talking about the gap, filling the gap? I don't know if that's what you meant by that comment or not, but until there's some kind of bullish signal here in the last, I mean, over the last few days, we got, I mean, I hate the big gaps like this, which is, granted, this is only a couple of them, but some stocks like Baba gap almost every day. I don't like those. I usually stay away from them. But as of right now, at least in the short term, this thing is looking more bearish than bullish. If there was some kind of indication, some kind of pattern that shows up that says that we're going to bounce back to the upside, then I'd be interested in the bullish side of it. But as of right now, I mean, I can't see anything here that says that this thing's probably going to go higher. If anything, there's more indications saying that it's more bearish than anything, with the big gaps and the big volume, and it looks like that's all earnings driven and some kind of news driven. So that's the only thing that would make me nervous about a bullish side. Does that make sense? Yesterday's chart. Yes, it is. So let's look at it in intraday. What's it doing today? That's what the next thing. I just usually like to analyze. I'm so much more familiar with Omega charts than I am TOS. So Yeah, it's up today. So if we're looking at an hourly, if you're going to day trade it or do maybe a really short-term swing trade, then yeah, we could, throw obviously there's some resistance, some intraday resistance there on the hourly chart. And then I have to go to a daily, but find some, the next resistance level looks like it'd be right up about 20. So this could be a good short-term trade. So the question becomes, where's the stop at? Put the stop there. I put the target right at 20. Whoops. We're running out of time. Question is, and of course it does that. 1890. I'm going to move that down a little bit, actually. Just I don't want it to be right at a round number. I'm going to get my calculator up here real quick. Wasn't expecting to use that. So let's see. We'll make that green, actually. Yeah. You're going to see real quick if we can. Let's see. Throw some numbers in real quick and see if it's worth going. 1896, 1998, close enough. 97, we'll take that. 1921. So it's a little bit beyond that. I mean, if you hopped in first thing this morning, this is where, I mean, based on the trading plan, as far as using a 3-to-1 risk reward ratio, then put the stop there. Target been 1998. The entry point's 1921. So as of right now, it's a little outside of the range where I'd get into it as far as a short-term trade. But yeah, like I say, I mean, the daily chart definitely does not look bullish. Today it is. Will it continue? That's always the ultimate question, right? Yeah, I would agree. Will says there's other candidates that may be better, but what was the other one? ET. Let's take a look at ET real quick. Another one. This is this is a theme of last week. Quite a few descending triangles is what I see here. Again, short term, at least we're in a downtrend, right? Lower highs, lower lows. Is it up a bunch today? Yeah, because I'm looking at RRC is up a bunch today. Huge amount. So let's see what the intraday is. Is it rallying too? A lot of energy stocks are. So yeah, this is up today. The question becomes, will it break out of the downtrend? And it depends on where you want to put this. Go off the closes. I guess it's technically out of there, huh? So this one I can see, if it breaks above this most recent high a couple days ago, then yeah, maybe. See what there is there. Oh, this I just noticed is a $10 stock. Yes. Well, that definitely can be a catalyst. A lot of insider buying a few days ago. That also begs the question of why. Then again, if insiders are buying, then doesn't necessarily matter why, right? Yeah, as far as the range, that's possible. Oh, this is a daily up to, yeah, there's a little bit there about 1020. So yeah, I think a break above about that 952, 960 area would create a bullish scenario. Which I guess isn't a big surprise. Because, you know, with what happened yesterday in Afghanistan, the oil prices are probably not going to come down. I don't know how big of a factor that is. But obviously, the market's got real bullish on energy stocks, at least oil stocks. So that makes sense as far as I'm trying to see who was that. Oh, Clyde. Is that clear? I mean, at least what I'm seeing. And actually, I guess we have, okay, good. You're welcome. Get back to that, ET. You could also look at this. This was tricky is with today's move, because this is obviously intraday. There's a miniature little inverted head and shoulders if it continues higher. Because we're up, what was it on intraday again? You'll see what I mean. Get rid of that. So we got a left shoulder here, head. I don't, left shoulder, head, if it continues, a right shoulder. But you're talking, let's see, what's the low there, about 9, 50 or 60 cents a run. So that's something to look at too. Whether or not it plays out is hard to say. Just keep deleting that. No, not on Omega charts. I thought they got rid of that intraday updating ability, or did they bring it back? I don't worry too much about it because I have this, obviously. So count the last 3 big candles as a pole flag. Which one was that on? Was that on Vail or ET? Will? I just saw your question there. Yes, Rob does have a great gap trading course. On Vail. Whoops. I'm so used to using the Omega. Oh, there we go. So you're asking about this. Oh, not Vail, on Qs. Could it be, what was the question again? Oh, the 3 last big candles as a pole. Yeah, it's a good observation. So Will's asking if it could be considered a flag. We do have basically a rising 3 forming today, as long as it closes up there, right? I mean, we're only halfway through the day, so the market could turn over from here. If it closes where it is today, then yeah, we have a rising 3, almost a mat hold taking place. And if there was big volume, then that's a good continuation pattern. But then again, that still brings in the question of, is this a flag? Kind of. But yeah, I wouldn't be surprised to see it keep going with the momentum that we've had here, and then the rising through methods. So again, I always look at it from an odds perspective, going, okay, if it's already moved this much, what are the odds it's going to continue to go? So, and I'm not suggesting not take the trade. What I'm saying is that you might want to take a little smaller position. In other words, I would pare back my risk some because of the fact that it's moved so much, and the odds are that we're probably going sideways, even though it very well could go up. And it sounds a little crazy. I'm in a mindset of, I'm always looking at the odds and go, okay, if the odds I think are smaller that it's going to continue to run, then I'm going to take a smaller position. I don't avoid the positions. In other words, it's a fear management tool. It's something I use for, okay, I'm nervous that this thing's going to turn over and reverse here because it's run so far, so fast, but I don't want to miss the run if it does go up. So instead of doing 10 contracts, maybe I'll do 5 or 3 or 7, depending on what I think the odds are. Does that make sense? So again, I'm not one of those all in, all out type of traders anymore. I used to be when I started. And then I realized that I missed a lot of trades because I was scared to get in with a full 10 contracts because the risk was too high. And then I missed the trade and then I'd be upset. So I finally figured out, if I just pick up 1 or 2 contracts, or a small position relative to the risk and the odds, when you calculate everything into it, and you say, okay, here's the odds of this happening. Here's how much risk I want to take based on those odds. That makes sense, hopefully. I do not, Clyde. I know VWAP has gotten a lot of attention lately. I've looked into it a little bit. I'm not that familiar with it. I've seen it a little bit, and I know there's a lot of people that talk about it. And people say it's a great indicator. And I'm not saying it's not. The main thing I'm looking at is price. Price and volume are the two main things I use. 95% of my decision comes right off the price and the volume, which is obviously relative to patterns, right? I'm always looking at the pattern and seeing what that's doing, then the price action, and then what's the volume telling us. So there's a couple hundred different indicators out there. There's all kinds of different things you can use. And what I tell everybody is use what works for you, right, Will? I mean, we talk about in the patterns of flash class, like fibs. I'll go analyze the chart, draw lines, do this, come up with a trading plan. And then they'll be like, well, the fibs are showing the same thing. Right? We'll say, yeah, no doubt. Because the beauty is that a lot of indicators, a lot of times will ultimately get to the end result. You'll get to about the same thing anyway. So I tell people, use what indicators you like, use the ones that work for you. If you love Fibonacci's, use them. If you get into VWAP and you like VWAP and it works for you, use it. If you like patterns, use them. Use what works for you. We're all a little bit different, right? Just like I use the analogy of, a burger joint, right? You can go to McDonald's, you can go to Wendy's, you can go to Burger King. Conceptually, they're all the same. Do they have a little bit different menus, a little bit different secret sauce? Yeah, they do. But at the end of the day, you're still getting a burger. You know what I mean? So whichever indicators you choose to use, whichever burger you want, use it. So as far as JetBlue goes, very similar picture, right? We've got kind of a descending triangle, but also could be considered a double bottom. There's a funny part about patterns is that a lot of times they can be more than one. So then that's why it's important to wait for a breakout, because you don't know which one it's going to be, right? Good. Thank you, Clyde. Appreciate that. I think I finally used that analogy enough where I said it a little bit more succinctly than I have before, but yeah, it's like any other business, right? And trading is trading. And for the most part, generically speaking, technical analysis, charting is charting. So I would agree with that, Will. Don't try to reinvent the wheel. I tried that already. 20 years ago, I tried it, and I tried it for a few years, and it doesn't make any sense. It doesn't work. So I agree. Don't reinvent the wheel. That's one reason I love patterns. They've been around forever, and they're consistent. They work. They're repetitive, and that's the beauty of it. So any other very quick questions? Getting close to 3 seconds. Oh, yeah, I think you're talking about the cues there. Did I miss any questions? Look real quick before we go. Call it a day. All right. Well, that will be all we have for the day then. Appreciate y'all coming out, hanging out, having some fun. And we will see you on the next go around in 3 or 4 weeks. Y'all take care. Have a great day. God bless. Bye-bye.